Good morning. We welcome you to the BYU Real Estate Webinar Series. I am Troy Carpenter, an Associate Teaching Professor of Finance in the Marriott School, and I'm sitting in today for Dr. Barrett Slade. It's a brisk, rainy day here on campus and along the Wasatch Front, but the colors have been absolutely gorgeous here this fall. We invite you to join us next month, Thursday, November 16th, when we will welcome Clayton Wyatt, co-founder of Vesta Ventures. We look forward to next month's presentation when we will discuss residential growth, opportunities, and property tech. Please watch for our invitation to register for this webinar in the next couple of weeks. Those of you on today's call, we welcome you and your questions and invite you to submit those questions by clicking on the Q&A button at the bottom of your screen. We'll get to those as time permits. Today, we are pleased to have with us in studio Kip Paul, Vice Chairman at Cushman Wakefield. Mr. Paul is a well-known and respected in the industry and has transacted deals totaling in excess of $9 billion over the past 40 years. He is joined today by his two associates, Michael King and J.T. Red, Senior Associates at Cushman Wakefield. Welcome, gentlemen. It's good to have you here with us.
Yeah, great to be here.
So I think Kip and Michael, JT, will go ahead and have you begin your presentation, and then we'll do some Q&A following that. So
thank you, Troy. We're honored to be here and to participate in your program. We'll start with one of my favorite quotes from Charles Darwin that basically indicates it's not the smartest that survive, it's not the strongest that survive, rather it's those that adapt the best to change. And certainly the market that we're in right now in the commercial real estate business is certainly a time of change. Today, we're going to just, we know we're tight on time. We'll talk about headwinds and opportunities. We'll talk about a tale of two markets, public versus private markets. We'll quickly touch on some of the core fundamentals for Salt Lake City, and then quickly go through each of the asset classes.
Yeah, so just to kick us off, we thought we'd talk more macro, right? And I think, a lot of headwinds, are plaguing the commercial real estate market right now. And just to list a couple, you've got the Fed policy, what Jerome Powell's doing with interest rates. You've got, with the rising interest rate environment, you've got local and regional bank health question marks. You see the collapse of, Silicon Valley Bank and Zion's credit rating as well. Getting hit. And so I think, local and regional bank health is top of mind. You've got geopolitical issues and wars in Ukraine spooking the markets. We've got an election year in 2024. And right now, what we're really battling is a lack of data, right? There's not a lot of transaction volume. So not a lot of data points for investors to really understand where the market is currently. But chaos creates opportunity, right? And so some of the new opportunities that we're seeing, it's the start of a new cycle. A lot of analysts, and I think we all believe it, that, one of the best buying opportunities of our generation are going to be in, call it 24, 25, once we start, once the market really bottoms out and we start that recovery. We're a reversion to the mean, right? I think the pendulum swung too far in one direction. It's coming back to where it should normalize at. And so really, not terrible news in that regard. I think that the low interest rate environment that we had prior really just allowed investors to get ultra aggressive on yield. And now that's swinging back in the other direction. You have the opportunity to buy at the bottom, right, at better yields. With the lack of construction due to inflationary pressures on construction costs, future supply gaps, I think, are going to be a big opportunity for developers that can figure out a way to go right now. With the adjustment in office, you've got, conversion opportunities, new use theses that can be applied. And then finally, I think the real estate market commercial real estate market really hasn't changed over the past 50 years. And so, when the market's down, it's prime for disruption. So I think you're going to see a lot of new interesting concepts, technology, enter the marketplace here over the next few years.
So this chart basically visually demonstrates the decline in values for various product types from the peak of the market to where we are today. And you'll notice there we show both public and private markets. And the theory here is that the public markets are more forward-looking as to what is coming. It's a little more efficient market than what the private markets are. And so this might be an indicator showing what some of the private transactions and what the values of properties may be in the not too distant future. You can see that the private markets have not declined as much as the public markets. And of course, office is the one that is currently having the toughest go of things.
And I think just to add on to that, it's the big REITs have the most data right now. And so where the private markets are lacking with data and understanding of really where is pricing right now, the public markets have that data available. And that's why I think we're seeing a lot of the differences in the declines. So let's dive into Salt Lake City core fundamentals. You know, investors can't control the macro, right? They can't control interest rates. They can't control leverage levels and equity availability and all of these things. But what investors can control are the markets that they invest in. And investors are hyper focused on markets with really strong core fundamentals. And Salt Lake City and Utah as a whole checks a lot of those boxes. So a couple major categories that investors are very much, you know, top of mind is job growth, economic diversity, population, fiscal stability, and then finally kind of GDP contribution and growth. And across all of these product types, Utah ranks in the top 1, 2, 3 across the board. For example, Oxford Economics recently released a study that forecasts Salt Lake City being a top 10 metro for job growth over the next 5 years. Very, very positive core fundamental. The Cushman Index, which measures economic diversity, has Utah as the second most diverse economy in the country, which helps us weather storms better, right? We're not hyper dependent on one industry like, you know, hospitality or you know, vacationing or anything like that. We've got mining, we've got financial services. Goldman's second largest operation is here in Utah, right? So very diverse economy. Millennials now make up the largest workforce in the country, and Utah is the youngest state in the country with a median age of 31 years old, right? So we are capturing a lot of that new largest workforce in the country. U.S. News and World Report has ranked Utah as having the nation's best economy overall, as well as the country's #1 overall state and #1 in fiscal stability. And you know, investors want to do business in business-friendly states. And then finally, over the past 10 years, the state of Utah increased its share of national real GDP by 20%, which was the largest margin across any state in the country. And that's significant because that is the main drivers of that GDP growth are, you know, in migration, job growth, all the core fundamentals that you want to see in a market when you're investing in commercial real estate.
Yeah, so, you know, going into the different submarkets now, I think it's important maybe we start with office, which has likely been the one we've been answering the most questions on. We see it in the news a lot. Everyone's questioning, hey, what's going on with the office world? We see a lot of distress. We see vacant buildings. You know, what's the story here in Utah? You know, I think there's an argument to be made and kind of connecting back to what Michael said with the in-migration here into the state. You know, Utah's weathered the storm a little bit better than some of the other perhaps more coastal markets. You know, we took a stance on COVID that was really solid, and we also still had people coming into the office. And that's not to suggest we were immune by any stretch of the imagination to the impacts of work from home, and we're still working through that now. But what we're seeing now is more of a migration to kind of a hybrid work concept, right? And a true flight to quality for office product. So, you know, 95 state industry are probably the best examples in our market of buildings that, you know, were in lease up or, you know, just in lease up around COVID, and have done very, very well. I mean, 95 state is probably 75% leased. Industry is full. In those buildings, it's amenitized, you know, they're true class A. And for employers in the state of Utah, I mean, you look at recruitment and retention of talent, right? And I think the days of IBM or any big corporation where your grandfather worked there, your dad worked there, and now you're going to work there are likely over, right? And that's probably a product of pensions as well. But now we have people changing where they work every 2 to 3 years. So recruitment and retention is critically important throughout this state, you know, and throughout the country, really. So to do that, you need to have well amenitized office space because it's the culture. It's a culture that's bringing people back. So if we go to the headwinds and the various opportunities, I mean, the natural headwinds are, you know, lack of tenant demand. And I think for Utah specifically right now, it's just a matter of saying, hey, how much space are we going to need and when do we need it by? So as a result, we've seen a lot of direct and sublease space. So sublease space being space that an existing tenant had and said, hey, maybe we don't need this anymore. Let's market it and have someone backfill it. So we have a lot of that on the market right now. And from the capital markets side, it ties in pretty directly with the leasing world, because, if you have a building that is, say, 100% occupied, but there's sublease space, there's questions as to whether or not people will backfill it, right? And when we're looking at financing, I mean, it's really, really tough right now to get financing on office product. Everyone is looking at unleveraged returns versus leveraged returns just because there's minimal financing available. And then naturally you have geographic hurdles as well, right? So any kind of call center oriented space that wasn't amenitized, maybe in a market that wasn't super attractive, those buildings have struggled a little more than maybe your core buildings. And if you've got Utah, the I-15 corridor is prime. We have great buildings there, well amenitized access. But if you're kind of not in the core areas, we've seen some notable softness. Relative to opportunities, I mean, we feel there's a lot of opportunity in office right now. You can get product well below replacement cost. We've seen buildings out to market at $200 a foot. They're probably $400 to $500 a foot on replacement cost. And while there's going to be some headwinds probably for the coming years, it could be a good buy, just dependent on where you're going to be located. We've also had the conversation is, repurposing to alternative uses. So maybe converting to multifamily for some of those buildings that perhaps, aren't in great markets, and that's dependent on things like floor plates. But when you zoom out and you look at Utah, we have significant tech, significant legal, and significant healthcare drivers throughout the state. So the tenant activity and demand is there, and we're above average compared to some of the coastal regions, San Francisco, New York, Chicago. So we're positioned really, really well to come out of this. We're just at a point in time right now where we're shifting into what is going to be the new norm. So we're working through it, but generally speaking, office has a lot of headwinds. There's a lot of bad press out there, but I think, if you're looking at good product, it's going to be okay.
I would just add, we're office guys. We're in the office every day. Our team's in the office pretty much every day, and we find it to be the most efficient way to conduct our business, right? And I think we're starting to see a lot of the large occupiers, the big groups, starting to see those inefficiencies and really push for back in the office.
Exactly. I mean, we're a 6-person team, and for us to be in the office, we have to be in the office. Because for us to communicate effectively, turn around and say, hey, Michael, hey, Kip, here's a question, what's the answer to it? Versus getting on the phone and having a more formal process. It's tremendously helpful. And we recognize there's, perhaps some engineering jobs or whatever it may be, or maybe you don't need to be in the office. But I think having that hybrid where you could get the team in there, you could be communicating, it's a positive. And I think companies are realizing that now, but you have to be sensitive in how it's approached.
And then finally, just to touch on what JT said about conversion opportunities, we are seeing that in the downtown Salt Lake City market now. Hines is converting South Temple Tower, historic kind of 1950s vintage office building and premium location. They're going to be doing luxury apartments, and so we are starting to see that concept start to trickle into our market.
So the retail market, we're all aware that it certainly took its beating when COVID first hit. We all kind of adapted the attitude that we were never going to go shopping again, and everything was going to be delivered by Amazon. I kind of joked with my wife that we don't need a front door anymore or a front porch. We just need a loading dock. But retail has now rebounded, and to the point where vacancies are actually pretty tight, and lease rates are actually moving upward. It would be very challenging, very difficult for a developer to build a new shopping center in today's environment. And so I think that trend that we're seeing is very positive for retail. Up until just recently, with the last kind of upsurge in interest rates, retail, you could actually get positive spread between cap rate and debt. And so we think it's a bit of a early contrarian play, but we think it's a very solid one. In terms of headwinds, the required yield is increasing just like it is on other assets. The most preferable assets are those typically grocery anchored or shadow anchored. And the other, which we don't have a lot of those in our market, the dominant grocers own their own product for the most part. And the other concern would be household debt levels, both savings rates and consumer credit card levels. Opportunities, there is availability of debt for retail centers, as opposed to how JT was touching on. There's perhaps little or no debt available for office buildings. Lenders, because they've reduced their exposure to retail, are now wanting to get a little bit more exposure to retail. And like I say, up until just recently, you were able to get positive leverage. But even today, with the higher interest rates, you're still able to get neutral leverage. Limited competition, we touched on that real quickly. Be very challenging for a developer to develop a new center unless you're already under construction. So as the market continues to grow and expand, that's going to put more upward pressure on lease rates.
Yeah. I would just add too, I think we're seeing a resurgence in retail when it comes to mixed use projects, right? For the past 5 years, incorporating retail into apartment projects was more detrimental to yield than it was accretive. And now we're seeing that, with the health of these retailers, interesting, unique retail concepts doing really, really well in some of these downtown mixed use projects like West Quarter, which is Charles Meridian Hotel, an Element, as well as Post District, which is, office space. Traeger's new headquarters will be in there. They've got, I think it's 15,000, 20,000 square feet of retail at some record-breaking retail rent numbers. And so we're seeing it finally start to happen where we're creating true live, work, play districts, not just apartments here and retail centers here, right? True mixed use is coming to the market. And I think that's driving a lot of the overall rents up for both multifamily and retail that are in these mixed use projects.
Driving walkability is really, really important, especially for multifamily. I think now we're seeing a push relative to the tenants where, hey, they have this great apartment, but they still have to get in their car and drive somewhere, right? So having well amenitized spaces with a retail component is really, really important to drive the foot traffic, but also create the neighborhoods we're talking about, the 9th and 9th of the world, Post District, downtown Salt Lake City, creating these neighborhoods that are walkable is kind of the big push now, and they all tie together. Office, retail, multifamily, hospitality, they all tie into one to create this kind of urban living core.
Mm-hmm.
So it's a really important aspect of it.
Yep. All right, let's touch on the multifamily market here. The visual that you're seeing, we call this our skyline map. This is really interesting. One of the newer concepts in our market are high-rise multifamily developments. This graphic kind of gives you a visual of the changing skyline of Salt Lake City. We can touch on all of these, but I want to focus on one really, and that's Astra Tower. That's a developer out of Boston. Kensington is doing that, and Silverstein out of New York is their equity. 39 stories, going to be the tallest building in Salt Lake City. And they have topped out and will begin pre-leasing here over the next, call it 12 months, hopefully to deliver the full building by the end of 2024. The interesting note on that one is the last we heard, their all-in cost to develop Astra Tower was $770,000 per unit, and that is by far the highest dollar amount for any new construction in the market, and we really don't have any comps to support that pricing right now, because towers are a new concept, right? Nobody's proven it out or tested it out, and so very new concept, and in order to hit the yields required to do this, they're going to need some very, very big rents, likely north of $4 per square foot, again, unseen in the market. So we're going to test the depths of the luxury market for sure. But I think, with Cowboy Partners project, Liberty Sky, that delivered about 18 months ago, 21 stories right by Astra Tower, has been incredibly successful. And then additionally, the Ritchie Group and Garn Developments project, the Charles, which is an 11-story tower, is going through lease up right now, also really, really successful. So I think, we are testing the depths of that market, but all is pointing to, high demand for true luxury high-rise units in Salt Lake City. So some headwinds on the multifamily front. I think From an investor sentiment, multifamily and industrial are still a crown jewel if you can find it. We are a low velocity market here in Salt Lake City, so we don't have a lot of willing sellers, specifically in the current market that we're in today, where there's just a lot of instability, a lot of variability on where things are going to shake out. So until we have that certainty, I think it's if you are able to ride out the storm, owners aren't willing to bring assets to the market right now. Couple other headwinds here that we're facing on the multifamily front would be the supply pipeline. For 12 straight years, we had county-wide and really both Salt Lake and Utah County sub 5% vacancy, right? And so we've had a housing shortage forever and ever. We then kind of starting in 2016, 2017 had the big construction boom of apartments coming up, and that has continued to today. And so downtown Salt Lake City is going to see 2 back-to-back years of very high deliveries, about 10% of our existing inventory base, which is not insignificant, but we view it more as growing pains than anything else, right? We kind of have a lot of supply coming over the next couple of years. That supply will get absorbed, and because there's nobody going on new construction now due to interest rates and inflationary pressures on the construction costs, there will be a supply gap coming in 26 and 27. And if developers can figure out a way to deliver new product into those years, they're going to have very limited competition when it comes to new supply. So kind of a headwind, but also an opportunity down the line if you can figure it out. Affordability is absolutely top of mind for a lot of developers right now. We are very quickly losing our affordability story in Salt Lake City, just due to the pure demand and essentially being landlocked, right? And not having the ability to continue to build affordable single family residential homes and the ability to kind of sprawl out. We don't have that luxury in Salt Lake. We got mountains to the east, mountains to the west, lake to the west in the north, and lake to the south, right? And so very difficult from an affordability perspective, but it's something that a lot of leadership, a lot of very important real estate players in the market are hyper focused on. And so, I think affordability is something that we're going to want to focus on here over the next few years. Another headwind is the bid-ask gap right now. As we were talking about earlier, not a whole lot of data in the market. There's only been 4 transactions year to date of 100 units or more on the multifamily side. And that is not enough data to give investors conviction of understanding where the market is today. And so, owners of multifamily in the market have still very lofty expectations because they're seeing comps at 5 caps and things like that, whereas most buyers are looking countrywide across markets, and they're seeing movement in cap rates widening out in other, call it high growth markets like Nashville and Charlotte and Austin, and I think the fear is that is going to continue into our market, and so when we're doing BOVs, we're trying to be realistic with owners, but it is difficult to kind of bridge that gap and get people to understand truly where the market is due to the lack of data to support it. And then finally, on the construction side of things, yield on cost requirements. So for development, that's how you measure the profitability of a future development. Yield on cost is the one metric that equity is hyper focused on when they're looking at capitalizing a multifamily or really any construction project. And yield on cost, they want to see about 150 basis point spread between their yield and where cap rates are today. And because the cap rate is such a variable, moving, fluid metric right now, it's very difficult to understand where yield on cost is, hence pausing a lot of that new development that's currently in planning stages. Opportunities, I think the lack of affordable housing, again, is it's a headwind, but also an opportunity. Limited new construction in 26, as we talked about. Ability to buy below replacement cost for existing assets is also a great opportunity. And then again, prime for disruption on the multifamily front.
Yeah, so relative to hospitality, so through COVID, it was another one of the asset classes that took a pretty hard hit. We saw a lot of conversion projects underway. I mean, I think our team probably did 700-800 units of just conversion from hospitality to multifamily, kind of micro apartments. Coming out of COVID, so call it 21, hospitality in Utah started performing very, very well. I mean, we saw 15-20% gains. And all hospitality types across all classes. So the ones pictured here, so the Hyatt in downtown, more of a convention center type hotel, brand new product, and then immediately next door you have Element and Le Meridian, and these three hotels have caused a bunch of traffic in a good way, foot traffic to be downtown. So when we talk about drivers of activity for multifamily and for these urban cores, hospitality has been a pretty significant portion of that. And it's not just in the downtown core. I mean, you go along I-15 and you find, a Ramada or a Motel 6, and say, hey, that's old, it must really, be challenged. They perform very well. We have a lot of people that are staying there as they're kind of between apartments, or if they need temporary housing, or maybe they just want affordable, weekend stay options. And, hospitality has continued to perform very, very well, particularly coming out of COVID. So right now, as we talk with groups specific to downtown and Granary, so Granary being just south of the Salt Lake City downtown core, everybody's saying, hey, hospitality may pencil really, really well, and it's going to drive traffic to the area. So it's really exciting to see that start to pop up. I mean, I think most of our product in downtown Salt Lake City, outside of the projects we discussed, are 20-year vintage. So it's starting to shift a little bit now. That being said, we do still have some headwinds in hospitality, labor being a big one. Front desk folks, cleaning folks, really, really tough. Wages are increasing, which obviously is a good thing, but it's shifting kind of the dynamic as far as how profitable hotels are. So we may see increases in ADRs as a result. So we're monitoring labor shortages pretty closely in the hospitality world. The second one is PIP obligations. So PIP is a property improvement plan for a hotel. It's essentially the brand required upgrades to keep them all pretty consistent. Through COVID, they were all delayed for the most part. And now that we're out of COVID, the brands are starting to say, hey, time to do your upgrades, and that could cost anywhere from, $10,000 to $40,000 a key, depending on the scope of it. So that's a big cost that operators have coming down. The next one is a looming recession and its impacts on travel. I think we have a lot of travel back, but if we hit a recession, maybe people pull back and start, spending less money. So we're watching that pretty closely as well. And to Michael's point, multifamily is low velocity, hospitality may be even lower. So very few trades in Salt Lake City, and most of them off market. Opportunities, return of business, group and leisure travel. We see that now. Business travel is almost fully recovered. Group travel is back. Then leisure travel, I think coming out of COVID, everybody said, hey, I haven't traveled in 2 years. We're going to go do, 4 vacations this month. So it's definitely back strong. We talked about the deliveries in downtown Salt Lake City, lack of future supply, and then the new thing is extended stays. So, I think a lot of people when they're traveling now saying, hey, we love a normal hotel room, but also it'd be nice to have maybe a little 2-burner stove, bring the whole family in there. And we see a big push towards extended stay concepts as well. So.
The industrial market, as Michael mentioned, the two top categories right now from investors are multifamily and industrial. The industrial market in Salt Lake City is white hot. It's beyond robust. Salt Lake City has become known as Crossroads of the West. And as you can see from this aerial map here, Utah, Salt Lake City is very central, certainly to distribution for the Western United States. That lighter colored yellow area is essentially a one-day truck ride. So we're very close to being center of servicing everything west of the Mississippi. Headwinds include lack of new supply due to construction costs. In 2022, the market delivered and absorbed about 10 million square feet of new construction, new product. In 23, we're scheduled to deliver about 6.5 million square feet. Half of that is already pre-leased. And in 2024, projection right now is a little over 3 million square feet. So we are definitely an underserved market. And due to that, that's obviously keeping lease rates up. The cost of construction is what is slowing down new projects. So we've got to find, the market's got to find itself there, find a new balance in there. One other aspect of that is we are starting to see some sublet space come on the market, which will hopefully ease up on that lack of space. So we're hopeful that'll help the market find itself there. we're also struggling with, I'll call it the affordability story. Some of our prior success where we tout ourselves as being, low cost labor, low cost utilities, low cost of housing, attractive lease rates for industrial. Our success has now eroded a lot of that, if not made a lot of it disappear. So to some degree, we're a little bit of victims of our own success there. The other interesting factor is lack of developable land. When you look at the Salt Lake Valley, it's essentially football shaped. And it appears there's a lot of land on the west side out by the Kennecott mine, but most of that mountain, most of that land is owned by Rio Tinto and Kennecott, and they're never going to let anybody encroach on their mine. That's a very profitable operation for them. So that's now forcing developers, users to go to, let's call it outlying markets. And those hot markets would include Spanish Fork, Tooele, and markets even going up further north like Brigham City. Opportunities, we just touched on that. The other big trend that we're seeing are these, I'll call them mega data centers. In fact, they call them hyperscalers. And these guys build with all of the demand for not only call it the usual technological information and storage of it, but AI is now layering on another big requirement for that fact, for that market aspect. Lack of new development, we talked about that. Where we do think there's demand that's not being met by the market would be smaller size spaces, incubators, lower ceiling height, shallow base space. That's a market that's probably been a little bit overlooked and underserved.
That's it. That's what we got for you.
Well, that's a wonderful presentation. We've got a few questions that have come in from today's audience. I just want to refer back to your one slide on the price declines. Are those declines mostly from cap rate increases rather than NOI declines, or both?
I think it's both, but I would say the biggest impact is cap rate changes. NOIs have decreased in some sections, just because of supply and demand, but the biggest impact is definitely cap rates.
Okay.
Yeah. When you look at your quote unquote risk-free rate of return with what the treasury markets are doing, for example, right? You can get a 10-year treasury bond right now and it's yielding, 4.5%, 4.75%. And those were cap rate levels kind of, really even wider than that peak of the market, right? Cap rates got compressed for industrial and multi to 3.5% levels, right? And so real estate should always have some spread and yield, right, over that risk-free rate of return. And so with where treasuries are today, also moving interest rates, that's really widening out, call it investor required returns for all of these asset classes. I wouldn't say any of these are immune.
Right.
Let's go back to the discussion on conversions, office to residential. A question came in here. Have you seen any successful conversion, and can you provide an example of one?
Yeah, so Michael mentioned South Temple Tower, who's the Heinz is a sponsor there. They're in the process of converting now, and that'll be kind of true Class A luxury. American Plaza, which is also in downtown Salt Lake City, 5-story building, I believe. That's also wrapping up, the process of being converted. So we're about to see how successful they're going to be. We anticipate they'll be pretty successful. A lot of it tied to amenity base and pricing. But naturally, I think it's a good reuse for office product, provided, there's a lot of nuances like floor plate sizes, where the building mechanicals are, all of that determine, hey, is this going to be a successful project to convert? But if it has all those, check boxes checked, and then it should be okay. So to answer the question in a short way, we're about to find out.
All right.
There's a third project, HK Tower, that's also going to be converted.
Okay.
And as JT mentioned, the key to a successful conversion from office to residential is floor plate size. If an office building has too large of floor plates, it's not conducive to the layouts for apartment buildings, for apartment units. So if you have smaller floor plates, that makes for a good conversion project.
Yeah, but you can't underestimate the risk of conversions, right? Because you just don't know what you're getting into until you start opening up the walls, looking at where all the mechanical and the plumbing and the electrical and everything is. And so there's certainly risk associated with it relative to new development where you can control everything ground up. But I think that the groups who are willing to take the bet and go and convert some of these historic, perfectly located, A plus office towers into new luxury apartments, I think they're going to be extremely successful, specifically on South Temple, which, as you know, one of our most prestigious streets here in Salt Lake.
Still sticking with office a little bit, you mentioned that, your six person team is, back in the office full time. But from what you're seeing right now, what percentage would you say are full back in the office, or a hybrid, or still some holdouts, if you will?
Yeah, so utilization, if you're looking at downtown, is probably 60%. As you spread south, I think it could vary from there. Really dependent on user type. I mean, law firms have been some of the most active tenant groups in the market, all getting back in the office. Goldman Sachs has been pushing people to get back in the office countrywide. And then as you enter the tech corridor, so where we are now, Provo, and then, spreading up through Draper, we're starting to see the more tech-oriented companies start to say, hey, maybe you start working to come back into the office. So it's a little bit hard to measure, but it's really dependent on user type. If you're a true call center user, I think those groups maybe last to fully kind of get back in the office. But if you're anything team-oriented, anything meeting-oriented like we are, most of those groups are back. Yeah.
Do you see us converging on a kind of a hybrid approach, a couple of days back in, or 2 or 3 days in the office? And
yeah, we're of the opinion that I think the 8 to 5 work day may be permanently shifted. I think if you need to go get your kid from school at 2 o'clock, go do it, plug back in when you get home.
Sure.
So I think we're gonna have flexibility there. I mean, you drive I-15 on a Monday or a Friday, and it feels a little bit quieter than Tuesday, Wednesday, Thursday. So it's dependent on days. And I think what we're seeing now, it's called hoteling, and that's where you don't have an assigned desk, but you show up that day and you just kind of pick a desk in the space and you work from there. And historically, it's always been, hey, this is your desk, this is where you sit. And now we're kind of starting to see a rotating workforce a little bit, dependent on which day they're in the office.
Sure, sure. A couple of other questions that have come in here. At one time we thought the brick and mortar retail was dead, and now we're seeing a comeback. Might the same thing be possible for the office space? We've kind of addressed that, but
Yeah, 100%. I mean, if you have courage and you have capital, it's probably a good time to buy an office building.
Yeah.
But that's easy for us to say, a little harder to do in practicality. But I think our belief is that you'll see the same thing happen with office that we saw happen with retail.
Yeah.
The market will find itself again. Nobody's going to build any new office product anytime soon. Eventually, it'll all fill back up, and it'll be a different office world than what we know it. But we still think that's a very good contrarian play if you have that conviction.
Yeah, great. Another question. Do you think that construction costs will come back down to a level that will allow for more projects to go forward?
I don't think so. I mean, commodities are always going to jump around. Labor has moved up in this last cycle, and I don't think you're going to see labor come down. That's pretty much cast in stone. When you talk to some of the older, more seasoned developers, and you say, have you ever seen construction costs come down substantively? The answer is no.
Speak to the concerns that refinancing costs are prohibitive in some cases. How concerned are investors right now about refinancing?
Very concerned.
Very concerned.
Very concerned. I think that, again, talking about motivating factors of trading assets in today's climate, it's partnership pressures, right? Guys who don't agree on, the path forward for a specific asset, and it's debt pressures, right? It's maturing loans. And so the groups who bought at very low cap rates and made the assumption that they could refinance at certain debt levels that are no longer achievable, there is going to be some pain, and there is going to be some challenges there. And quite frankly, that's really the main driver of what we're seeing drive sales to the market right now, is the lack of the ability to refinance at debt levels, interest rate levels that are accretive to the cash flow of the asset. And so you got to make a hard decision. Either it's cash in refinances, non-cash out, so you got to put more capital in, or you got to sell the asset.
Another question here. Why do you think there's such a spread between the public markets and the private markets?
I think the public markets are better at anticipating what's coming down the road. I mean, you would say the same thing about the stock market, and I think that's what you're seeing with the REITs and the public markets there. I think they have more data, as Michael mentioned, and they're better at being forward looking.
Yeah.
So that should be a sign for what's coming in the private market.
Sure. Let's jump back to multifamily in Utah. You said there is a supply pipeline headwinds, lack of affordability. So do you not see any drop in prices any longer?
In asking rents, is
Yeah.
that the question? We are starting to see that happen. Supply is doing what supply is meant to do, right? And so the more supply we have, the more competition these developers have with new Class A and new product in the market. And so we are starting to see a heavier concessionary environment, offering with projects offering up to 6 to 8 weeks free rent. And then when you kind of amortize that over a 12 or 14-month lease term, that is material changes and call it your overall lease rate that you're paying. And so I think, we are starting to see that. And as we get more supply in the market, I think that does continue to trickle out to some of the suburban markets as well.
Wonderful. Well, gentlemen, it's been an absolute joy having you here with us on campus. We have some students with us on the call. I think I'd like to hear from all three of you. You perhaps a little bit closer to where they were, but do you have a nugget of wisdom that you might offer as we have students getting ready to graduate and move into the market? JT, let's begin with you, and then Michael, and then Kip, if you could share your parting words of wisdom.
Yeah, so I mean, our story may be similar, Michael and I, but when I graduated from college, immediately kind of dove in and tried various things. I knew I wanted to be in commercial real estate and tried various things, different asset classes, retail, office, and just kind of got to know what I wanted to do. And then obviously learning from the best in the business, Kip over here, is tremendously helpful as well to have him as a mentor. So I think finding the team, the right fit, the right asset class, if you're looking for, it doesn't just have to be real estate, it can be whatever it may be that you want to do. Just kind of getting in there and trying a bunch of different things, and then finding what you like, and then finding, someone you could work with and learn from, was probably the thing that helped catapult us, or at least me, the most. So
Yeah. I would say don't be scared to get your foot in the door and start at the bottom of the totem pole. When I graduated from University of Cincinnati, wanted to be in a smaller high growth market, and Salt Lake checked a lot of boxes, but there really weren't any job openings at that time other than the front desk job at Cushman Wakefield here, and degree in commercial real estate finance and economics, and I took the front desk job just because I said it's the only way for me to get my foot in the door. I was able to build relationships with a lot of the brokers, and was fortunate enough to continue to move up the ladder. But if I didn't take the job, right, and just get my foot in the door and maybe take a job that I felt like, this isn't what I want to do, this isn't, anything I'm tremendously excited about, but just, it's going to open, more doors. I think if I didn't do that, I wouldn't be sitting here. I wouldn't be, on this team. And so I would just say, don't be scared to just start at the bottom and put the work in to build your way up. Right.
Love it. Love it.
So my nugget of wisdom is maybe you better think twice about getting into the commercial real estate business. If you're under 40 years old, all you've seen is nothing but an upmarket. Yeah. And some of the prominent developers would ask their team, have you ever thought about the possibility of rents going down? And the young guys, that doesn't happen. Well, now we're seeing it, and now some reality's hitting. We get asked a lot, what are some of the, I'll call them secrets to success? And we could talk about 100 different items, but to me, they all kind of fall into three main categories. Number one, and these will sound very simplistic, but I think they're very, very true and very accurate. Number one is work hard. If you're a new young guy in the business, you need to be the first guy in the office, and you need to be the last guy to leave. And to that point, if you're not in the office, if you're working from home, you're not going to build relationships with older guys. I maintain I learned more just by listening to other brokers talk, because, the brokerage world doesn't really have a formal training process. So be the first one in the office, be the last one to leave. Second one is relationships. Relationships are everything. You got to work hard to build each and every relationship, and then you've got to work harder to keep those relationships. We've had some of the younger guys say relationships are a thing of the past. It's all going to be about technology. I completely disagree with that. Technology will help us be more efficient, but it is all about the relationships that you make and keep. And then lastly is just be creative. I like to say if you're creating, you don't really have competition. If you're doing business just the way every other broker does out there, you're just one of another 1,000 guys. So be creative. Do we change the use? Do we do an assemblage? Do we buy a campus of buildings and sell them off individually? I mean, just think about things differently. And once you can solve problems for your clients, that's how you tying back to the relationships. That's how, if you can solve their problems, they will become loyal to you, and you'll have a good business and a good life.
Love it, love it. Well, thank you, gentlemen. And thank you all for joining us today. That concludes our webinar for today. We thank Kip, Michael, and JT for being with us. We remind you of our upcoming annual BYU Real Estate Conference held here on campus in the Hinckley Center, Friday, November 10th. A link to the registration for the conference was in the bottom of the announcement you received for today's webinar. We'll be sending out another announcement here within the next week. You're also welcome to contact me directly by emailing troy.carpenter@byu.edu. Thank you and have a good day.